All right, good afternoon, everybody. Event Trader here. Going to be joined by Brett Manning, who is, of course, Chart Trader. Brett, how are you doing today?
Pretty good, Gav. How you doing?
Doing good, doing good. I think me and you are going to be talking a lot with each other this week with the Fed meeting and all the central bank activity that's going to be going on. Before we jump into the show, you want to provide any thoughts on what you're seeing today? I know you took that NQ long earlier. Tough sledding to get anything going in any direction right now. It feels like ahead of that those Fed headlines.
Yeah, right. But I think we're still in an environment where I have at least an upside bias to blow out the highs that we saw a few days ago. And then we'll see what type of rejection we get there. And I think that it makes a lot of sense to me to maybe see that into the Fed decision, especially given the exposure information that we're about to cover and the likely bias that the Fed's going to present.
Yeah, so it's definitely pretty lined up. I think early expectations for you, Brett, is no move by the Fed, and then setting the table for a July rate cut, basically.
I think that so my running theme is that they've got an active conversation that goes on with the Fed funds futures. They don't always agree, but when the Fed funds futures get a strong idea in their head, the Fed either needs to correct it or acquiesce to it on some level. So it's very clear that the Fed funds futures version of the market expectations are saying there's almost a certainty of a cut in July. So if the Fed is not on board with that, they're going to need to be very clear about it. Otherwise, that's going to continue to be the expectation. So I think that just the Fed basically continuing with whatever linguistic patterns they've been putting out there, that they really need to do whatever they need to do to support the cycle, that there's a big problem with inflation expectations right now, and there's risks including the trade war, et cetera, et cetera. I think that those will be all the signals that are really necessary, and I think that will just continue to present this idea that we're headed for a cut in July. And if the Fed has a problem with that, then we'll hear about it pretty clearly.
Yeah. So, interesting sentiment and flow show for us today, Brett, because I suppose we're talking about things that in the course of the next 2 weeks can be completely turned on its head, I suppose. But I think that's probably why the key word that both of us were seeing in terms of a lot of the sentiment readers was neutral. Now, obviously, there's a lot of big question marks on the geo side with central banks and trade talks, of course, with the G20 lined up. But also, this is basically a typical formation that you see forming after you hit a case of either extreme positive or negative sentiment. In this case, we're coming off a extreme pessimism from some of the indicators that we're rolling into now, more of a consolidation period, I guess you would call it.
Yeah, I mean, we saw the type of sentiment extreme that really suggests a lot of big money, or what is usually called smart money, but doesn't necessarily mean that it's smart money, but institutional money, probably a lot of long-only equity, probably a lot of hedge funds that move to a real kind of decidedly pessimistic view of equities into the June 3rd lows. And I think that we're working out of that right now. And one of the stats that we'll probably cover at some point, I'll just give a little preview of it, is one of the things that I like to see as a strong indicator to define a context is sentiment indications or exposure indications that take a while to build up and then represent very large time frame extremes or records. And a good example is in 2016, coming into Brexit, we had, I think, something like, don't quote me on this, but I'm going to go with my gut. I think it was something like between 80 and 90 weeks in a row where the American Association of Individual Investors bulls were significantly under the long-term average. And it took them, it was like a year and a half worth of data of being significantly under the average level of bullishness. And that's when you really know that you've got some strong upside potential, because it takes a while to burn that off. And in this case, what we have is what the B of A stuff called a record disconnect between credit and equity flows, where over the last 24 weeks on a cumulative basis, if you take investment grade, high yield, and emerging market debt fund flows, and you subtract global equity fund flows from them, you have the largest number we've ever had. In other words, that there's the biggest slant in favor of non-sovereign fixed income flows relative to equity flows. Nobody's been buying stocks, and we're talking for nearly 6 months, and it's the biggest all-time disparity between those two. And at the same time, a couple weeks ago, we saw the biggest. I think was it the biggest or the second biggest 1 week flow into government bonds. So you could just see how pessimistic large money managers are toward equities, and that's at a time when we just got back to seeing the dividend yield on the S&P float just under, for at least a day or two, float just under the 10-year yield. So it's an odd circumstance of massive pessimism from people who are managing large amounts of money, and that's something that takes a while to work off, and that's why I have a long bias right now until I start to see action that proves that wrong, because you've built up a kind of pessimism and lack of exposure to equities, and I think you were seeing something with options data that suggested that the rally could be accounted for as a kind of removal of hedges, but again, that's a flat squeeze.
Yeah, I mean, just to highlight what you were talking about, Brett, we've had a record $46 billion of inflows into government bond funds over the past 6 months, and that would include. Well, actually, no, because that would have been right around when Powell turned dovish, because that would have been January 4th, right? That meeting that he had with Yellen and Bernanke, when he kind of started pulling back from that December hawkish commentary. So that's been one thing that's certainly been seeing a lot of that government bond flow too, I think. But yeah, the number that I was looking at, Brett, because I was postulating that it wasn't so much of a buying rally that we were getting over the last couple of sessions as much as an unwinding on the hedge front. Sort of, I think you've referred to it as a flat squeeze, if you will. And some of the data that we were seeing, the S&P 500 open interest for institutional, which from my understanding would probably encompass a lot of that Lobo that we saw unwound, flipped from minus 446 billion to plus 330 billion over the last week, as basically investors recovering short positions. So certainly I feel like there's probably an element of you can't fight the Fed there with that action. Would you agree with that?
Yeah, I mean, I think that they've taken a one-sided directional idea of the market. And when you're talking about a lot of these guys, the Lobo stuff and exactly the statistic you just brought up, probably the majority of it is people who, revolve around a net long position that's either barely net long or massively net long. And those hedges take them down to, something like flat.
Sure.
And if the market starts to rally in the face of that kind of positioning, then, they're in a career jeopardy situation, because the one thing you can't do as a professional money manager is be bearish in a major bull market. You can have the opposite be true, because you probably got a bunch of people on your team. But when you get a market that performs well and you don't take advantage of it, it's kind of the biggest career risk out there. So I think that, yeah, I mean, when you're presented with the possibility that we could see the Fed cutting rates with all-time record unemployment and the S&P break out to new all-time highs, and you're not exposed to that type of market, I think that that's something that doesn't look good, at year end. And I think that probably you're exactly right. I think that that's hedges being covered rampantly as the market holds support.
So we're still looking for something that's going to get those buyers in there. But there was something of interest with on a sentiment trader site that was catching my attention, Brett, and that was the breadth and volume in which stocks have risen. And they were talking back in January about this weak breadth thrust, which is something you've seen a little bit, and it's kind of reminiscent of what I thought you were talking about in terms of underinvested money managers. So we saw that pop up in January, where I think it's 10 days in a row. It's got to be up. The up volume has to be above a certain level. And since then, we've seen that teeter off just a little bit here, but that's still bubbling under the surface here, and it was one of the main reasons why you are kind of staying long. So, have you seen any updates in any of the sentiment readings that would support your thesis at all?
I mean, I haven't seen anything other than that we're recovering from a bearish extreme in a situation where I think that there's probably still a reasonable case to be made of a kind of wall of worry dynamic developing out of this if we start to see a supportive Fed. And again, I'm not necessarily making the case that we're not nearing some kind of economic cycle end. Is very possible, but you generally have a situation where when the Fed first starts to ease, you tend to get new highs, and then when you roll over after that is when you really start to see a problem. I mean, we saw what was the Fed? It was August of 2007, I think, was the first cut
Yeah.
last cycle, and
No,
the market.
I don't believe it
I
was
think it got 75 basis points.
that was the surprise cut that would have been the following spring in 2008, no?
No, there was the 2007 cut before the October 2007 highs, the ultimate highs.
Right. Okay. So, and, okay, yeah, I got to double check the dates on that.
I think it was the
surprise
first cut of the last cycle was in 2007 before the move up through to new highs. We can double check on that. But,
I'll go back and double check all the dates, but yeah, no, I don't think you're far off. But yeah, I mean, I was going to agree with you. It's not a surprise to get a blow off top before getting a tougher downturn in the markets, similar to what we saw. You know, most of the selling, while the issues were starting in 2007, most of the selling didn't really start until 2008 and into 2009, of course.
Right. Certainly.
So that wouldn't be a surprising pattern to see at all. So if we're talking about that, then what are you expecting to see from the Fed on Wednesday, and what kind of impact do you think it would have on the markets?
I mean, I think that we could kind of get exactly what we just discussed, that you see the Fed basically continue to prepare the markets for a cut in January, unless there is some kind of surprise resolution at the G20, which looks like an extremely remote possibility. I mean, there is a middle ground possibility. So the Fed is basically, I think the Fed's mode right here is to say, we've got G20 coming. We're going to see how that matures. We want to cut right now, but we're not going to cut because we're going to see where that goes. Because I think that probably behind closed doors, they don't usually use language like this, but I would imagine that the conversation behind closed doors is something along the lines of the uncertainty that the trade war is presenting is one of the principal elements that is driving down business investment, because it's very difficult to plan because you don't understand what the rules are going to be. And so if that factor weren't there, would we still be in a situation where we would want to be cutting rates? And it's tough to say, because if we cut rates now and then there's a resolution at G20, people are going to blame us for a policy error in the other direction. And so I think that they're leaving the situation open for the possibility that there's at least something that is constructive. You might not get that July cut, for instance, if what we get out of G20 is what appears to be a real commitment to get back into the type of place that we were in around trade back in March, where we had the sense that, well, we haven't got a deal signed, but there is a prospective deal that's on the table that both sides are reasonably confident in. I don't necessarily think that's going to happen, but it's not impossible, and it probably would change the trajectory of things for the Fed, because you probably have market participants start to make different bets and businesses start to make different bets if they felt like there was a process that had a potential endpoint. But right now, the way that it stands, I think that conversation is, this is going to be with us through the 2020 election, and there's going to be a lot of very difficult decisions and probably a major wet blanket on serious commitment of capital by the private sector, and that's going to be a necessary headwind. That's probably going to be something that we need to cut into, because we can already see one statistic I saw on Friday, and I don't know if you saw this. I posted something on it. The Michigan Sentiment Indicator showed a new all-time low in long-term inflation expectations, and that's exactly the kind of thing that keeps that cut front and center. So I would imagine that we're going to see a conversation that has to do with trade and postpones the cut until July, but reaffirms the likelihood of it, barring some kind of serious movement toward, or at least in the direction of resolution on trade, even if it's not put in those words.
Yeah, and obviously on the sentiment thing, we also got Empire and NAHB kind of following that Michigan sentiment number, where that soft data is really starting to dip in and see some of the pressures from the trade wars. I know for the Empire, the 6-month look ahead dropped to its lowest level in, I think it was 2 years. So, and the overall reading was in a negative territory for the first time in 2 years, and saw the biggest month-over-month decrease in that period. But it's funny because it goes back to the theme of perhaps the administration's just setting everything up to get the Fed to move, and then as soon as the Fed moves, they'll jump off onto the other side of things. So, because it is that simple, really. If you think about it, they could just turn off the what you may call it, the tariff increases at any point. There's no, it's that easy to turn it on, that easy to turn it off, and I think that's the problem that people are having with it in terms of trying to plan around this. So,
Yeah.
but you wonder if the administration, with all the information that they've gotten from the IMF, the New York Fed, there was the report from the Chamber of Commerce. There was over 600 companies talking about the impact that tariffs would have on the U.S. consumer. And you wonder if it's just enough for the administration, that they've got enough light shed on, kind of like the cockroaches in the corner of the room when you turn on the light. For anybody that had too much of exposure to China, that now they've gotten them at least scurrying out of there to Vietnam or to Indonesia to find other areas of sourcing material, and whether or not that's enough of an accomplishment for them that they won't even turn on the tariffs.
It's possible. Yeah, right.
I think that's possibly an interesting aspect, and in which case the G20 meeting, if they meet, perhaps if the president thinks that it's a little bit of an out for the tariffs, that they could postpone putting on any of the tariffs. I think that would be a pretty good showing if you got a dovish Fed and then you got that sort of response from the G20. So again, though, it's tough to really gauge the sentiment going in ahead of that, and I think that's why we've seen so much on the neutral territory. I think, Brett, you kind of highlighted that in your chart book there, where you set up the whole beginning reading as being a board member trying to argue one case or the other. And I really think that the fact that, it's kind of so much uncertainty in either side really highlights the sentiment data that we're seeing out there.
Well, yeah, and the other point I was trying to make by that little supposed scene was the sense that it's easier to sell to some kind of committee structure that you can't be long stocks right now, which is exactly why we see institutional money where it is. And yet at the same time, it may be that there is a picture that's even more compelling, but it's harder to sell to a committee, that the other side of the table is where to be. And I think that defines things for me pretty much. The reason why I have a long bias until I see something that suggests a tape where there is a new lead blanket offer coming in. It looks like that case was too easy to make for people, and they're in a situation now where if we start to flip things the other direction at this point, there's just going to be so much catch up to be played that it's really kind of, it's a powder keg possibility to the upside if we start to solve some of these problems, if we do it with low inflation and low unemployment, if we're making new highs, if we're making it with a Fed that's still accommodative, and if we're making all of that happen while you've got so much capital that's been sitting up, on the sidelines or piled into fixed income that really wants to be in equities if the equities environment looks constructive.
So let's just take a look at some of the levels that you'd be looking at for a potential lead blanket offer, or is it really, could it be show up anywhere? Because I mean, the S&P, obviously you're looking at that 2950 levels sticking out as that quote unquote double top level from back in August 2018, and the areas where we're seeing in late April. Is that one area that you'd be looking at?
So it's not so much levels, it's just the sense that there's a mode of behavior. And right now it looks like there's people fighting this tape, yet there's a sort of faucet that maybe doesn't make sense to them that's been switched on. And there's money starting to flow in. And it probably is removal of hedges. It probably is balancing out exposure by people who have to almost think in terms of hedging against the upside. And it just feels like that. Like just when I'm my sense of the order flow is there's headlines that knock it down for a few minutes, there's little shakeouts, but there's this kind of faucet of money heading into the market right now, and there's a lot of reasons to try to fight against it, but the market seems to keep on kind of, popping higher here and there. And that sort of environment suggests to me that, there's whatever the opposite of a lead blanket offer is on the bid is just kind of operative right now. And if I start to see the feel of that shift, if I start to see a sense that we're just getting ground to the downside with a steady offer and occasionally headline-driven pops to the upside, they get ground right back down. If it just feels that way to me more on an intuitive level, then I would probably start to shift my bias. It's just kind of my sense of the way the orders are going.
And then the flip side would be the Fed doesn't move. They don't tweak their inflation and GDP outlooks enough. And we see it pop to the downside, but then we go up, and then G20 comes out,
Yeah.
no deal.
Right.
We see it pop to the downside, but then grind back higher.
That would suggest all of that.
That would be the flip side of your thing. Do you think we could rally and break out, though, without implicit monetary policy assistance and a trade deal? That would be the most amazing wall of worry climb of all time, I would think, no?
I'll tell you what, if all of that happens and it starts to look and feel like that, then boy, you've got to be bullish because something else is going on. And I'm willing to set aside my ability to rationalize why the market's doing what it's doing most of the time, as long as I can see very clearly what it's doing. And if you start to see that kind of thing, then it will probably make sense in retrospect a year from now. But it's tough to see it in real time. It just always looks amazing in real time, and the further away from it you get into the future, the more sense it seems to make. And that's generally a heuristic for, thinking about markets. Usually, the important things don't make a whole lot of sense when they're happening, but you look back on them and you put the pieces together and it makes a lot of sense. So, we'll see if that's, this could be that we get exactly what you're saying, and because there's a resurgent growth boom underneath the market. There's a trade deal that comes along, and you look back historically, and interest rates are still historically low. And, earnings start to, I don't know if any of this is going to happen, but I'm saying there's all sorts of ways in which there may be a logic to a move like that. And the most important thing is starting to sense that the market is resistant to falling even on obvious things that make sense to everybody as bad news. That usually means that everybody's getting malpositioned, and eventually that's going to balance out. So, I think it's important to be sensitive to that, not believe that the market is stupid and fight it as it's making a move like that. But I would imagine, given everything I just said, throw it aside, I would imagine that the type of environment that could force a repositioning, as we said, the last 6 months have been constant flows into fixed income, constant flows out of equities, just across the board. That's an undeniable fact of our current situation. And if you start to see, the Fed cutting with 3.6% unemployment and the S&P making new all-time highs, then, right or wrong, like as long as you get those pieces together, it's going to be awfully tough not to get people managing large portfolios to rebalance their exposure, which means buying.
Right. What are some of the key sentiment indicators you're going to be watching to try to get a sense of which way people are leaning?
It's the same basic set. Just wait for something to start to look surprising. And I suppose at this point, if we start to move up through, it'll start to be looking for, are we starting to see a tip where people are really kind of in gear with the market? And are we starting to see that, push to where you have a lot of excitement starting to brew, in terms of the market? But I think that we're just so far away from that type of feeling. I suppose the main thing will be, if we see continued upside and we see a continued sense that sentiment is fighting it, particularly the more retail-oriented stuff. So the robo, along with the AAII data.
Right.
A sense that, and any time that there's some negative headlines that emerge, do we see something like the inverse ETF volume indicator spike up? Are we seeing things that are typically retail tools that show that there is a continued resistance to the idea that the market should be going higher? Because generally speaking, that's the sort of thing that accompanies a continued breakout. Something like we saw back in 2013 at the beginning of the year is always a great heuristical example to me. You were breaking out to new, I think we got to where we were breaking out to new multi-decade highs at that point, and it was it was something people were fighting so hard, even as we were just rallying day after day after day. And it just gave you the sense that there's, that it's an invincible trend. Eventually, sentiment is going to flip back to something where people are accepting it or excited about it, and that's going to be at much higher prices just as a function of money. So, I will look to see what narrative like that develops. That may not be what happens. We may see a pop higher and everything go to max bullish and everybody's fired up and the market is still not making new highs. And, we get all the good news in the world and the market's still not making new highs. And underneath the surface, you're seeing a deterioration of the cycle. That's the opposite circumstance. I don't know what it's going to look like, but that's the sort of storyline one way or the other that I'm going to be trying to spot to see which sort of environment starts to emerge as this market continues to plot out its pattern.
Yeah. One side complex here that we probably want to take a look at, Brett, is crude, which, you could look at it from a number of different ways, obviously, but the recent geopolitical issues that have arisen with the tankers being attacked off the coast of Iran's really thrown that into the spotlight, but haven't been able to get a rally from that at all. So, you follow it? Were you looking at the commitment of traders data from crude on Friday by any chance?
Yeah, actually, let me pull it back up to reaffirm. I know that a lot of shorts came in. I've been very interested in that market from the standpoint of the relationship between the sort of headlines that we're seeing and the sort of behavior that started to pick itself out on the chart. Now, right now we're sitting with the main number that I look at is the large speculators, and we're at 350,000 contracts net long. That's back down to a tame situation. That's certainly not vulnerable. We got up to the level that we were talking about when we started shorting crude intermittently here and there was significantly over 500,000, and that was the first time we started to get a tanker being hit by something in the Gulf of Oman back in was April maybe.
Yeah, beginning of April.
Yeah, I think it was. So it's been interesting to see that kind of catalyst can't seem to do anything for crude. And the fact that we've got OPEC already coming out and basically saying, yeah, OPEC Plus is staying together. We're going to continue the production cuts. We're going to continue to try to support the market.
Too, right? Isn't that one more item to throw on people's radars too?
We're coming there. Yeah, we're headed that direction. A couple weeks. Yeah. So, I think it's really interesting to see how poorly crude is acting in sight of that situation. And there's a couple of different possibilities. And one would be, it's and even with the Fed cutting, there's just not the type of energy, the growthy energy underneath the surface of the economy to really pick up the glut that's been built a little bit because we've had a number of big builds. And then the other possibility would be that the market is starting to see signs underneath the surface of a deterioration in the relationship between Russia's big producers and Saudi Arabia. And that's the other dynamic I think to really keep an eye on. It's something I postulated a little bit in my chart book. If you go back to 2014, 2015, the real narrative was OPEC got themselves into a situation where they realized, or wrongly as it turned out, what they needed to do was to take the bear market in crude into the deep end to drown the U.S. shale players. And that's what they tried to do. So they stopped cutting production. They let the market crash. They even tried to put out messaging to keep it down, to bring it down, because, lo and behold, Saudi Arabia can produce for $16 a barrel, and still make money with crude at 20. But most shale producers, particularly at that time, they needed crude at 54 to 58 to be able to make money on it. So I think that it was a case at that point where they were thinking, we can't control what these independent producers are doing, and right now they're pushing a ton of volume out there. And the only way that we can really regain control of the market is if we drown them. If we take this thing down and we leave it at 25 or 35 for 6 months, and they all go out of business, and then we let it come back up. And that's because if they keep cutting and supporting the price, every single month they're just losing massive market share to U.S. producers. So, the idea is they've got to cut production, they reduce how much they're putting out there, and the U.S. shale producers just pick up production and fill in the gap that's creating and take market share, and they're really not doing anything to help the market. They keep it stable, and they just churn mega profits for these U.S. producers. And my sense is the efficiency of U.S. shale producers had gotten so much improved over that time period. It was kind of a Darwinian process. The ones that went bankrupt were the ones that couldn't manage to survive that process, and the other ones just got leaner and meaner. And now we've got a much tougher animal to drown. And I think that I think that the big Russian producers are worried that if they commit to cuts, they're just going to be losing massive market share to the leanest and meanest of the U.S. shale producers. And I think that that's possibly presents a dynamic that the market is seeing, that OPEC Plus could go back to being OPEC, and that would be an enormously bearish development for the price of crude oil. So I think under the surface, there's a possibility that there's that narrative that's building, and we'll just have to see. Nothing else makes a lot of sense to me because the glut's not that big, and we've got, a dollar that's starting to weaken. We've got a Fed that's starting to cut, and, we've got production cuts reaffirmed, and we've got a possible war brewing in the Middle East. But that type of factor would explain that sort of action.
Yeah, and it's interesting to take that oil aspect, because for everything you were just talking about with the potential for a not a collapse in oil prices, but for it to go down lower than most people were expecting, that really ties the hands of the Fed too, in terms of not having to worry about that inflationary pressure coming in.
Sure. Right?
Yeah. So, but I mean, there's so many moving parts here, so many interesting dynamics. So we talked about some of the different areas that we'd be keeping an eye out on moving forward here. For the flow data, is there anything in particular that would be piquing your interest? Anything either on the European front or on the corporate side of things that you're watching closely these days?
I mean, it's all about the reaction to the situation that we're seeing develop, where the market is acting reasonably well in the face of some deteriorating economic data because the central banks are stepping in. And, if we see, I guess, another week of a significant flip in the large option orders that you talked about, and we start to see, massive flows into equities, that starts to shift the narrative a little bit, and maybe that we're in a situation where we can't really break out too significantly if things stabilize. And then obviously the other side of it is, how much of a deterioration are we seeing? Because politics does enter into this, and if we continue to keep the massive uncertainty on the table around trade, and we see, there was one, you mentioned the Empire State Index.
Yeah.
Before that, there was the Morgan Stanley indicator that was the business activity index that came out last week, I believe, that was a 32-point drop, all-time biggest drop for June. So very similar stat.
Yeah.
And I imagine that Morgan Stanley is...
And we got Philly Fed coming out as well later on in the week. And then perhaps the most interesting one will be the PMI numbers that are due out in the end of the month, or the end of the week.
Right, that's going to be hugely interesting. And I imagine the Morgan Stanley data is modeled off of something like the Empire State to front run it. And they both showed basically the same thing for June. And so we got April data that was good last week with retail sales and a couple of other data points that suggested, hey, things are stronger than you thought. But that was May data, sorry. So we got May data, but June so far appears to be really shifting the narrative in terms of where the cycle is and how much of an impact we're starting to see from the uncertainty surrounding lack of business investment and people feeling constrained and a sort of strike by capital investment. So, obviously that's going to, regardless of sentiment data, regardless of technicals, regardless of anything, that's a material factor in the evolution of the situation we have right now. And, the rate that's starting to deteriorate, and you're exactly right. The PMIs are going to be sort of the crowning part of that step here. Step that we're taking in terms of how confident people are that they should be making large, high-conviction capital investments in business expansion seems to be going off a cliff.
Yeah, and you could even throw in the zoo survey, too, is another one that's going to be out there. That's the German and European economic surveys, so they're also going to be playing in a role. And, just the central bank activity in general, too. In addition to the U.S., you also have the Bank of Japan, Bank of England, Brazil's out. You have the equivalent to the ECB Jackson Hole this week, so... it's just going to be a real headline-driven week, I think, that's going to make for some choppy trade moving forward.
By the way, I wanted to follow up. So there was a discount rate cut in August of 2007, and then a primary Fed funds rate cut in September of 2007 for 50 basis points, and then we made a new all-time high, and then we rolled over and crashed.
All right. When did the ECB raise? Do you,
They raised what, July, I think, didn't they?
I think it was
The
July.
single needle compass.
Yeah.
Yeah, that was or June. The crude oil blow off top basically pushed that. We were at like 140 in crude oil.
Yeah,
In
that's
June
got to go down as
2007.
one of the biggest policy missteps, one would think.
Unbelievable. Yeah, exactly.
So, all right, Brett, is there anything else on the sentiment side of things that we're missing here that you wanted to discuss? I know there was something about the indices that you're looking to get into here, but for the sentiment side of things, anything we're leaving out?
No, I think that, again, yeah, we captured it pretty well. We're in a kind of tremendously neutral kind of situation, and it's neutral following an extreme, and also that we've built up this kind of larger time frame extreme, which could end up being right. Again, I mean, the actual cycle is going to certainly bear on things, but it does. All of sentiment data analysis really is not about necessarily knowing precisely what the future is going to hold in terms of index movements. It's about identifying vulnerability. And the vulnerability here may be to the upside simply because we've seen 6 months of massive bond fund flows, massive equity fund outflows, in a situation where, we're about to get a possible Fed cut with 3.6% unemployment, which is a really rare phenomenon, and could possibly lead to, at the same time, a gradual healing of what's causing all of this lack of business investment, because that's really ultimately political in nature. And so you could start to see that hindrance cured, inflation remain low, the Fed remain on hold after cutting, and the indices making new all-time highs with a massive underexposure. So I think that kind of characterizes the large time frame sentiment picture, underexposure and pessimism, and then the short time frame sentiment picture is really one that's extremely neutral inside of that. So, and then the fundamental backdrop and the news backdrop is bearish, which is why the sentiment situation is what it is.
Yeah, and that's going to be so difficult for people to get their arms around in terms of price action
Very
and
tricky.
sentiment versus, because I mean, if you think about it, if we did get this move, it would be coming at a time where it's very likely, especially when you start seeing these forward indicators in the sentiment data, that people are going to be cutting guidance. We already saw it in Nucor earlier today. Analysts are going to have to be cutting expectations, and it's going to be really difficult, I think, for people to get their heads around the complete divergence between fundamental data and sentiment and price action.
Yeah.
Kind of what we're seeing a lot in the cloud computing space right now, which Scott's been talking about. We're just going to see it on a much more macro level, it feels like.
Yeah.
All right.
Right.
So Brett, you wanted to address shortly a correlation between indices. This was based on a feedback question, I believe, from Friday.
Yeah, I got a question some time ago that I failed to address in a timely manner, and I promised the subscriber that I would. And basically it has to do with noticing that there's a tremendous amount of correlation between the major indices. If you look at the futures, if you look at the NQs, the YMs, and the ES, and if you overlay a number of different indicators on intraday charts like stochastics or MACD or anything that you find basically stock and trade in your charting interface program, you can see the same exact patterns over time on intraday charts. That it's sometimes very difficult to see a sense that there is a difference between these markets, and is there a driving cause of this, or is there a way to look at this where you can start to see benefit or cost to choosing one of these indices over another? Because you and I are both kind of in the game when we're doing top-down equities trading, where we're basically selecting which of those three, YM, NQ, ES, we're selecting which one we'd short and which one we'd be long in a situation depending on what happens, and understanding the differences when they seem to be so perfectly correlated. And I wanted to explain my perspective on that for anybody interested, but especially this subscriber. So the way that I look at it is there's a difference between price correlation and what I would call directional swing for swing correlation. So they're going to go up and down at the same time, almost on every single time frame. And that's what causes what you're seeing. If the market in general, in quotes, is moving up, all the indices are going to be moving up. And if the market in general is moving down, all the indices are going to be moving down. And that's pretty much, going to always be the same direction 5-minute bar on all of those charts. But the magnitude is the important variable there. So you end up seeing divergences develop over time, where you'll see, for instance, on an up move, right off the bat, all the indices are going to move above their overnight highs, let's say, and let's say they all move above the previous day's highs. Then we start to get some kind of pullback and some kind of consolidation. Then we get a follow-through up move. But in the follow-through up move, the NASDAQ actually makes a higher high than it made previously that morning, whereas the Dow makes a lower high significantly, and let's say the S&P is somewhere in the middle. And then you start to pull back. They're all going to go up at the same time. They're all going to go down at the same time. And you end up with patterns that start to differ. And actually, Friday was a good example because we had what looked like more or less a bearish descending pattern in the NASDAQ at the same time as we had a very clear bullish ascending triangle in the Dow. And they were still moving up and down perfectly in sync pretty much at every single moment. But the difference is the magnitude of those swings, so the oscillating indicators end up being pretty similar, but the patterns themselves start to shift based on divergences. And that's because money flows among different sectors. And the big differences between them are probably, which should be somewhat obvious, is the NASDAQ is basically the S&P, but without the materials, energies, or financials. And so when you've got something happening in, let's say, the commodities or interest rate markets, that's the significant driver, you're going to see that shift. And across sectors, the Dow is pretty similar to the S&P, although the sample size is much smaller. So you have the possibility, for instance, of what we saw when Boeing was such an active. Initially, when the news started to break about the 737 MAX, we saw Boeing drive basically everything because Boeing is a price-weighted index, and Boeing is the largest component. So for a bit there, what Boeing did drove the Dow, even if it was completely at odds with, say, the FANG stocks, which were driving the NASDAQ. So you really got a maximum divergence there. But when you look at the NQs versus the ES, it's a little bit simpler because the sample sizes are larger. You're really talking about swing-for-swing differences in the pattern, even if something like the MACD looks identical. So if you're trying to pick which index you're going to buy, I would use pattern structure. Look for bullish pattern structure the way that I do in terms of flags, in terms of ascending or descending triangles or symmetrical triangles. Using pattern structure and divergences, something that's making a higher high against everything else that's not. Usually there's more money flowing in that direction, and that's something that's normally going to be more consistent throughout the day rather than turning on a dime unless there's a major sector impacting headline. So the correlations may look the same when you're looking at indicators, but if you look at the swing for swing correlation, you're going to see different patterns emerge because the moves, even though they're happening at the same time and in the same direction, are happening at different magnitudes. And I hope that clears it up for anybody interested, but especially the one subscriber that sent me the question.
All right, now good stuff, good stuff. All right, Brett, so obviously me and you will be talking a lot this week. We're going to do a little bit of a preview of the Fed show. We'll get out of time for that. We'll talk offline and let people know, and obviously commentary around the Fed. So we'll really be able to flesh out these themes pretty nicely for the subs. But I think at the point right now is that we're in a neutral territory, and as bad as things are looking, a lot of the sentiment and flow data suggests that we could be going higher. So be a little wary of the headlines and the wall of worry. I'm not saying that they can't play out because there's certainly things concerning, but I think that's why that neutral area that we're in right now is so we're kind of really entrenched until we get some more of the details fleshed out there, and hopefully this sentiment and flow show showed some of the upside that's potentially out there for people, so you're not going in just looking to sell or aggressively short things right now because that could whip back against you potentially.
Yeah, and I would say as a crowning final statement, the vulnerability in terms of positioning and sentiment is to the upside, but in a genuinely troubling context.
The infamous pain trade as I like to call it. So, all right, good stuff, Brett. Well, we did tape this. We'll be posting this either later this afternoon or tomorrow morning. And again, we'll get an update on when we're going to do our Fed preview show to you as soon as possible. But thanks for everybody that joined us, and we're going to get back to take a look at the markets here.
Thanks a lot, Kev.
All right, talk to you soon, Brett.
You got it.